we now look at the third leg of our trading triad, which is obviously trade management. And to me, trade management, as the Japanese would say, is as necessary as water is to a fish. One of the most common and dangerous misuses of candles, beside using them alone, and even if people know to use them in conjunction with Western technicals, is we need the third leg. We need the trade management. And what I mean by trade management, and again, this is the third leg of the triad, and some of these terms I've used before, but we'll just go into more detail. Being a market chameleon, adapting to changing market circumstances, candles and context. We talked about, for example, earlier today, about which candle signals are more powerful. We talked about the progression of the white into the black, and normally the more the white gets into the black. But it depends on if it's confirming a support area, or it depends on the risk reward. So we always have to look at the candles within the context of the overall technical picture, risk reward, and exit strategies. Obviously, exit strategies is part of the risk-reward equation. Because we define risk, we're defining our exit, our protective stop. And one of the things about protective stops we're going to look at later when we talk about protective stops is we have no control over where prices are going to go, or we might have a profit target, or we have a target, but we have no control of that. Where we do have control is setting the price that says we're wrong. That we have complete control over. So we're going to look at these in context. So being a market chameleon, adapting as the market changes. And, we're all detectives in the market picking up the little clues, and we may have one position or one outlook on the market, but one of the great things about the candles, it lets us get those turning signals, those tipping points very early, and it could give us a clue that something different in the market. So, for example, the market broke above a resistance area, not a major break of resistance, but nonetheless broke above resistance. Again, I would like to see this confirmed by volume. But even if it was confirmed by a high volume breakout, anything happen the next session? The doji, right? And also, what else? The failure to hold above the highs. But even if you don't remember about, the failure to hold above the highs, the falling off the roof, the upthrust, whatever you want to call it, the market is telling us it's something different now. And with that, certainly, if you were long, I would certainly be scaling back on long positions, because as good, and I don't want to say as good, because I would have liked to see the break above resistance a little more vibrantly, but assuming, you do things in black and white, a close above resistance is a close above resistance, even if it's by a couple of, this happens to be this is a stock, a couple of points, a couple of cents, or whatever it is, it's still a breakout, but the next session would tell us it's something different, and we should adjust our position accordingly. And the reason I call it a market chameleon, as a chameleon changes its color to the environment, so we change our stance according to the environment of the market. Okay, here we have a nice bullish engulfing pattern. Nice because how many candles did it wrap around? 3. And once again, it can wrap around 100 black real bodies. Doesn't mean the market's going to be that much stronger. Candles don't give price targets. Just a high probability that the market is going to rally. It should be a potential good support area. I don't know if it actually held a support based on the close. So far it did on this chart here. But the focus of this chart is really not so much the bullish engulfing pattern, but it's adapting to the market. So, okay, here's our potential. This would be my potential target. Why is my target there? A window. Now, obviously, when we get the bullish engulfing pattern, we don't know what this is. So we'd have to think about, we'll look at risk reward later on, but I think this looks like an okay risk reward trade, right? Just kind of eyeballing it. We want at least 2 to 1. So time progresses. Okay, what's that? And what else would get us nervous about that shooting star? Is it confirming anything? A resistance area. So although our target was initially the falling window, is the market picture different now as time progressed? Sure. We have a shooting star confirming a resistance area. Maybe take profits there. or definitely scale back on long positions. That's what I mean by being a market chameleon. Okay. Question? Oh, sorry, it's a small gap. This tiny window over here. Yep. Yeah. Yep. Mm-hmm. Everybody's putting on their glasses.
Wouldn't your first warning be the shadow on the very first?
This upper shadow here?
No, to the right. Up there, yeah.
Here. All right, the question is the first warning over here, and the reason for that would be, what's your opinion? Why would you think that would be a warning? You know, it's you know, you could view it kind of like a dark cloud cover, right? But are we seeing, remember, this is where we get to the strict criteria. A dark cloud cover really should show us a change in psychology. Is that a long white candle and then a black candle getting deeply into the long white candle? Not really. So to me, that's not an important signal. Where I would start getting nervous even before the shooting star is the market stalling over here also, which was confirming this resistance area. So even over here, I'd be a little nervous, but really the extra confirmation would come on the shooting star that pushed above the resistance area and couldn't hold above it. But even if it didn't get above the resistance, the shooting star was confirming the resistance here. So, and certainly, once the market, see, this was a support zone here. Okay, that was holding, right? So even if you did not exit there and take some profits and hoping that this support would hold, you know, we didn't know this was going to be support because it didn't happen yet, but we certainly know this was support and this was support. So then you got maybe a little confident that this support was holding over here and you're still long, hoping that it's going to bounce from here moving up. Once it broke under there, you should have been out of longs anyway. Okay, adapting to the market. So here we have a bearish engulfing pattern. This is a bank index. We can't trade this, but I just wanted to use this as a nice scenario. So we think about selling it here. Why do you think I have my blue line as a potential support area? What candlestick signal do we have there? Okay, why is that support on that blue line? A bullish engulfing pattern. Yeah, and there's also one down here, but exactly a bullish engulfing pattern. So nice risk reward, assuming we could trade this from the short side. Anything a little different going on here now? See a little support area unfolding, right? I don't know if it's quite a hammer. The lower shadow might not be twice the height of the real body. I would view this as a little bullish engulfing pattern, the white wrapping around the black. But even ignoring that aspect, we have 4 days in a row. Back 2 days in a row, remember we're talking about tweezers tops and tweezers bottom? That's not a big deal. But when you start getting 3, 4 days in a row, or let's say you look at 15-minute candle lines, 3 or 4, 5, 15-minute candle periods, if you're looking at a 15-minute intraday, I would start paying attention to this. So now I'm saying I would say to myself, okay, although our target was down here, the market is telling me something different, and I need to adapt. So scale back on short positions, take profits. Okay? Of course, there's new information in the market, and it actually rallied from there. Okay, we have 3 slides here. Let's start from the left. Bullish engulfing pattern. Let's say we buy, well, we wouldn't buy on that there. Why would we not buy? Right at the resistance area, right. When would we want to buy to improve the risk reward with this bullish engulfing pattern because it's near a Windows resistance area? But for a bullish engulfing pattern, where's the support area, the most important support? The lower the bullish engulfing pattern, right? So we would think potentially about buying at the bottom of the bullish engulfing pattern, because if we do there, is the risk reward good? Yeah, so, you know, if we're buying there. Now, so that's our potential support area. In the middle chart, the market moves forward 3 sessions. Okay, what do we have? On the middle chart, what do we have on the last candle line? A hammer. Now, where is our first support area? Is it still the bullish engulfing pattern? No, it's the hammer. Oh, yeah. All right? So the hammer now becomes S1. The bullish engulfing pattern is still support, but that becomes S2. So essentially, by the market advancing, in other words, giving us new information, the hammer now becomes first support, and look what happened. The low of the hammer became our support area. Okay, we'd have to analyze if by the time you buy it, if it's still a good risk reward, because obviously the window is still resistance. But the idea of this chart is the market changed. So initially we had one area support. The market moved forward, had new information, had another candlestick signal, in this case the hammer, and now we have to adapt our stance. If we're looking to buy, we now know the first support is the hammer. And this is what I was talking about. Once again, you know, it's on my other educational resources, but one of the great things about the crack and snap is your target is the most recent high. So this would be my minimum target, and the more liberal target would be up there.
Would you buy on the close of that day?
Yes, definitely. Great risk reward. The question is, would I buy on the close of that day? Although it's not a hammer, it's a crack and snap, you have a low risk, you say to yourself, the market didn't go down on bad news, what's going to happen on good news? Right? And good risk reward, certainly. And just to refresh your memory on the crack and snap, you don't need a bullish candlestick signal to do it. As soon as the market breaks above the broken support area, gets back above it, you can think about buying it if it's a good risk reward. Okay, we're now going to move on to candles in context, analyzing the candle signals within the context of the overall technical picture through the prism of the overall market. We have bearish engulfing pattern. Black wrapping around the white. Yeah. Although it's the last engulfing, we know it, at least it's not a bearish engulfing pattern because the trend is wrong. So obviously one of the things we need to look at is trend, and for those who didn't know that would have lost, this is a Forex market, could have been anywhere from $500 to $1,500. So looking at the context of the candles and the trend. Same exact signal, and this is a nice chart to show you the danger of buying or selling on every candle signal, even if you're testing the same candle signal. What are those two blue arrows pointing to? What are the candlestick signals? Hammer. Look at the hammer, the black real body hammer. Now remember, first of all, a strict criteria hammer is a white real body, so it's a little better probability of a trade. But let's look at this first hammer from the idea of candles in context, which also means where the candlestick signal emerges compared to where support or resistance is. So we have that hammer. Okay, what would we look at, by the way, to see the trend intensity? The ADX. The ADX, we'd look at that also. Okay. But, you know, we're just focusing on this now. A falling window, it's small, but it's there. So if you're buying on that hammer, your risk is to the low of the hammer, and your potential resistance, falling window. Okay. Would we do this trade? Or should we? No. And even if you waited for price confirmation to increase the likelihood of the hammer working, that means you're closer to what? To the resistance area. Okay, so this is a hammer here. Now let's look at the second hammer, the power line. Remember, it's called a power line if it's a white real body. Different scenario. First of all, it's confirming a support area, and I view that kind of as a tweezer's bottom or a variation of the tweezer's bottom. A classic tweezer's bottom would have the first candles along black real body, but I like those bullish shadows. But more importantly than that, think of the trade from where the nearest resistance is. Risk reward is much better. We'd still look for the falling window as potential resistance, right? The hammer as a support area, same signal, completely different trading strategies. Everybody get that? Rings true? The question is, we're waiting for price confirmation, and which confirmation would that be on the hammer or the power line, the white hammer, when you're saying we're waiting for price confirmation? The second hammer. Okay, so what he's asking is we'd wait for price confirmation. It would be, now this is the pros and the cons of doing something intraday. If you did price confirmation on a move above, let's say the hammer's closed intraday, the next session intraday, you would have been long on the hammer over here, right? Because it moved above it over here. And so you'd have to decide if by the end of the day the confirmation failed. My feeling is, even though the confirmation didn't hold into the close, is the hammer still holding a support? Yes, all right. So if you waited for a close, and I'll get to your question, if you waited for a close, you would have had to wait over there. We have the falling window, we have the hammer, and you were referring to the doji. Okay, and then what was the question?
Just that looks like a resistance area.
This, okay. What he's saying is this looks like a resistance area. We could have this as a little pivot high, maybe as a short-term resistance area. But to me, the window, especially since this was a little support area here, there's like a little breakaway gap, this to me is the more important stuff. But I would not disagree. This could be a minor resistance area. It's a pivot high. Yes?
Would that bother you after the first day you bought, let's say, before that, and then you saw that doji, although it's in the middle of a nothing?
Well, the question, okay, what you're saying is, would this bother me if I bought here? And I said, oh, okay, if we bought here, you're saying if we bought here, would what bother me?
No, go up, go over.
Over here?
Would you take some profits at your target?
Oh, sure. Okay, the question is, would it bother me if I saw this doji? There's also a high wave candle. The market's lost its sense of direction, but we reached the target.
So
You're out. You'd be out. Right. Well, I'm going to show you in a couple of minutes where you might not be out, where we'd be using a trailing stop to help lock in profit potential if the market kept on going higher. But based on what we've talked about so far, we would be out. The target was met. Nice trade. Done. Okay, which is a better signal, a trading signal? We have on the left what? What is this? Dark cloud cover. And to your right, bearish engulfing. Which is a better trading signal? How many say dark cloud cover? How many say bearish engulfing pattern? You're all wrong. You're all wrong. You don't know. And what I've been saying time and time again. Write this down. You got to look at candles in context. If everything is equal, we could say this, but the odds are everything's not going to be equal. You don't know. Let's go to the videotape, as I say, right? You don't know. You have to, when somebody asks me this, I'll say, show me the chart. Let's go to the video. You just don't know. So here, it's a trick question, right? To keep you awake on a Sunday afternoon, right? It's a trick question. You just don't know.
Based on your progression, though, it would be done.
It would be if everything was equal, okay? But that's not going to happen. So let me show you a case in point. Here we have a dark cloud cover. Here we have a bearish engulfing pattern. Which is the better signal to go short? The dark cloud cover. It acted as resistance. If you did that bearish engulfing pattern, is that a good trade? No, you're selling right at a support area. So you don't know unless you see it within context, meaning, is it confirming a Western signal? Is it a good risk reward? Now, you better get this answer right. Which is a better trading signal? Altogether, we don't know. It all depends, right? We would think, the Morning Star, wouldn't we? But now that we're so educated, it depends, right. I'm very good at saying it depends with my wife. It all depends. Should I do this or not? It depends on what you want done. Right. Whatever you want, it depends. Yeah. Okay, so for those unsophisticated, we would think the Morning Star, and it makes sense initially on the outside. Long black real body, small real body, tall white candle. Boy, there's a real shift in psychology. But let's look at the case here. Okay, here we have a Morning Star. Here we have a hammer. Which is the better trade? Hammer. Why? It's confirming a support area, right? The hammer's confirming a support area. What about the risk reward? It's a fine risk reward, okay? Maybe we'd look at change of polarity, but even if we were looking at change of polarity, it's a fine risk reward. Okay? If you buy it here, this is probably at least 2 to 1. If you're buying on the Morning Star, the Morning Star is confirming a support area, but what about the risk reward? It's 1 to 1. It's probably even less than that. It's more risk than target. So I hope you took that part away. It all depends on the candles and context. And that's why with the recognition software, you're going to be able to see the candle signals. You're going to see the hammer or the morning stars. And then you're going to have to decide if, within the context of the overall picture, is that a good trade to do. And once again, what you could do is also add Western technicals. Okay, ADX, moving averages, and so forth. Okay. Now, any questions on this? Okay. So we all know the answer to this, right? We don't know. We don't know. Okay, so before we take our break, let's look at my most important trading rule. I've made reference to this before, but I want to make it official. This is the rule. Write this down. This is one of the secrets to trading, whether using candlesticks or not, successfully. Tattoo it on your body, however you want to remember it. Risk reward. And that's 2 things. What's your price risk? What's the risk of the trade? And what's your price target? If you don't have a good risk reward, you don't do the trade. I don't care if a candlestick signal confirms a Western signal, including ADX. If it's not a good risk reward, why do the trade? Okay, bullish engulfing pattern, bearish engulfing pattern. This is another bearish engulfing pattern in the middle red circle. We would trade with them very, very differently. Because, now first of all, in this bearish engulfing pattern over here, okay, I don't think I'd sell short unless it's confirming resistance, but I would certainly considering taking profits on longs. Look at this bearish engulfing pattern. Why would you certainly not be selling short, even if it's confirming resistance? Exactly. It's at a support level. Same pattern, but completely different on how we use that pattern. So we could say normally a bearish engulfing pattern, confirming resistance, a high probability or higher probability short sell. But now we have to add the third leg of the triad: money management, trade management, risk reward. Bad risk reward trade. You have the bearish engulfing pattern confirming resistance, doesn't matter, it's a bad trade. Candles and Western technicals, and now we're doing trade management. We need all 3. Remember, like the gym, the health club? Cardio, strength, and stretching, same thing. Candles, Western technicals, and trade management. Waiting for time to ripen was a part of a Japanese quote. I don't remember the whole quote, but it's just a nice expression. So here we have a classic, a strict bearish engulfing pattern. You think that black real body is multiple size of the white real body, right? Right. That's good as far as the strict criteria is concerned, but as far as the risk reward is concerned, right, can't do anything with it. Now, in our literature, we'd say there are times to buy, to sell, to stand aside, and times to ignore candlestick signal. With this bearish engulfing pattern, we would say ignore the candle signal, but that's not really right. I wouldn't trade with it, but I wouldn't ignore it. What I would do is set up on your trading platform, and you certainly could do this in the software, have an alert. When this stock gets anywhere near the high of the bearish engulfing pattern, that's when you get the 40,000 volts of electricity or whatever the alert you want is, right? Right. Yeah. And so when the market gets near there, you get an alert, you start watching it, and here we happen to have a gravestone doji confirming the resistance. Much better risk reward. So we're using the high of the bearish engulfing pattern as resistance, just as we would use the low of the bullish engulfing pattern as support. So if you had an unusually long white real body with a bullish engulfing pattern, it's a bad risk reward. It doesn't mean you forget about the bullish engulfing pattern. You set up your support area, and if the market gets near there, especially if you get a reversal candle signal like we do here, then you could pull the trigger because we have a good risk reward. We have a nice tight stop out area. So let's review what we did we've gone through the basics of trade management. adapting to the market, being a market chameleon. We may have an initial target, but if the market conditions are changing, telling us that there's, say, there's a resistance area with a shooting star, a bearish engulfing pattern, we would think about taking some profits. Candles in context, the danger of looking at a candle signal in isolation. Dark cloud cover, bearish engulfing pattern. You don't know which is more negative because you have to look at it through the prism of the overall market. And my most important trading rule, as far as trade management is concerned, risk reward. So we're now going to look at exit strategies. We're going to be looking at 3 different types of exits. And the first one is protective stops. So that means protecting your assets. And keep an eye on the term here because I'm pretty proud of this. It's protecting your... Right, that's what it's really all about, okay? Protecting your butt. So, there's a nice saying, it's not Japanese, but I forgot where I got it from, but the race is not always to the swiftest, but those who keep on running. True, right? And that's what protective stops are all about. The ones, and I know this from working with lots of traders, mainly institutional traders, but the ones who stay around and get the good bonuses and make a lot of money are the ones who are able to take the stops, you're going to have a lot of little losses. It doesn't matter. You still have trading capital. The ones who are not successful have the 1 or 2 huge hits. They think they're smarter than the market. They initially may have a stop. They move the stop. The best time, by the way, to put a protective stop in is before you do the trade, because that is the time you're most objective about the market. Right? I mean, some traders who have perfect mental equanimity and could use mental stops. And there was one trader I used to work with it was E.F. Hutton actually, and he would be on the phone and he would be buying and selling, and I had no idea if he was making or losing money. That's really impressive. Perfectly calm. That type of person could use a mental stop. But the more normal person really should place a stop before the trade is placed. Now, when I was doing the candlesticks, as I was doing the research, part of my job is giving trading recommendations to the brokers. And as I did more research, more of my trading recommendations became based on candles. Now, initially, I did not let the brokers know this because I still hadn't revealed candles to the Western world, and I was still doing the education, the research. But I found the more I learned about the candles, the better the trading recommendations became, not only insofar as getting into the brokers earlier, as far as good trades, but helping them avoid bad trades. And with that in mind, this was the analyst. This is when I essentially was doing all my trading recommendations based on candles. And the reason I wanted to show you this is, beside having the best trading record, P&L record, these are all the analysts who are giving trading recommendations. Beside having the best trading record during that time period, what I wanted to show here is look at my win-loss. More losses than wins. How was I able to have the best trading performance with more losses than wins? Stops. Smart use of protective stops, and that's what it's all about. And the best traders will do this. You don't have to win more than you lose. You have to know the old rule is let profits run, and we're going to look at how to do that when we look at trailing stops, and also how to protect your trading capital, and this is what it's about. So here, it looks like we have a lot of promising turning signals here, and this is what happens. But if you get out early enough with a protective stop, it keeps you in the game. Nice hammer. As soon as the market closes under the hammer, if you're long, you're wrong. Okay? And this is the kind of financial pain it could help you avoiding. And we've all looked at how, and remember with the advanced candles, we looked at how to use many of the candle signals as support or resistance, i.e. protective stops. The low of the bullish engulfing pattern, lowest low, your protective stop. The high of the bearish engulfing pattern, your protective stop. Dark cloud cover, and so forth as a protective stop. If you want to do something intraday, or you want to set a stop on a level not on the close, like say you're not at the market in the close, you just want to set a stop out level, what you could do is look at what your profit potential is. So let's say we have the hammer here, and your profit potential, I'll make up a number, is $2 higher. for our 2 to 1 reward risk, if you're looking for a profit potential to $2 higher, what's your dollar price? What's your dollar risk? $1. So now what you could do is you could set a stop. If you're not, at the markets, you could set a stop $1 under this, even intraday. So we're kind of going backwards. We're defining what our risk reward is. We know what our profit potential is. Now we're adjusting our stop so we can have a 2 to 1 reward risk. So now exit strategies. It may be a little hard to see the text here. It says H.B. Winsdorf always knew when to sell. So again, many people know when to enter position, but very few know when to sell. So we looked at protective stops. And speaking of protective stops in a statue, the way to think of it with protective stops is sometimes you're the pigeon and sometimes you're the statue. You have to think about that. So, and it's interesting as far as protective stops are concerned, if, just to really pound in the importance of protective stops. I was at one of these Costco's or Sam's or something, and they have these little eating areas. So I heard a guy talking to another guy and how he fell and he broke his nose and he had to have surgery on his forehead, and it was just really gory as a description. So the guy said, how come you didn't stop yourself from falling on your face with your hands? He said both his hands were in his pocket at the time he fell. And if you're trading without stops, it's exactly what it's trading like. And think of that bloody mess if you don't put in a stop. So now I always walk at least with one hand outside my pocket. I mean, you don't think about it, but if you fall with both hands in your pocket, you're totally screwed, right? So learn from other people's mistakes. That's why I like reading biographies. So anyway, we're going to look now at time stops, and then we're going to move into trailing stops. So a time stop, one of the challenges the trader sent us before the seminar. Okay. Getting into a trade and just sits there, and 9 out of 10 times it's going to go against me. A time stop means you set a certain amount of time up that if the market doesn't do what you expect it to do, you get out of the trade. So we had a cartoon made up, of course. Okay, so if the market doesn't act as expected within about 5 sessions, that's based on my experience, then get out. So he's reading Great Expectations by Charles Dickens, and he's saying this isn't living up to my expectations. So I call it the if-then rule. If the market doesn't act according to what it should do based on the candles or whatever tools you're using, then think about getting out of the trade, because you're committing capital for a long time to a market that's not doing anything. So here we have a hammer and bullish engulfing pattern. We expect a rally, and it just sits there. You're just wasting resources. It's an opportunity cost, as they say in business, right? Same thing here. We have a bearish engulfing pattern. The market is confirming resistance. No real reversal signals here on the candles, but let's say you were selling on the bearish engulfing pattern, expecting the market, it looks like a good risk reward, to come back to down here. And it might ultimately do that, but it's doing this for time after time after time. And once again, it's subjective. You may be perfectly comfortable. You may not be fully committed here. You may be perfectly comfortable holding on to this position. There's nothing wrong with that, but my feeling is if the market's going to turn, it should turn within 3, maybe 4, at most 5 sessions. If it doesn't do it, it's going to either meander or break out in the opposite direction. Okay, this is the good part. Not as though the others weren't the good part, right? This is a really, really good part. So, and I'm sure we could all echo this. I take profits too early, giving profits back, being able to let my profits run, right? Want me to show you how to do that? Yeah. See you next week? Good. I'm gone. Okay. Yeah. Okay, let me show you. And this is where we're going to be looking at golden and dead crosses. And some of you may be familiar with the term already. But first of all, of course, we have a cartoon. I'll read this because I scanned this in. It's a little hard to read. As the market moves in a direction, the stop is adjusted according to help ride the trend. And the door says, Ed Burton, a really great trader. And the guy shaking his hand says, congratulations, Ed. Thanks to use of trailing stops, we're going to add another really to your title. Really, really great trader. So Yeah, I have a custom cartoonist. He's really cool. I give him ideas and gets back with about 3 or 4 different cartoons for me, and I pick the best one. So I have copyrights on all these. That's why we can do it on the DVDs. So, yeah, I tell you, when I try to make my seminars entertaining, I go all out, get a custom cartoonist, and yeah. So let's look at trailing stops. But first, before we do that, we're going to look at golden and dead crosses. It's a Japanese term. A golden cross means a short-term moving average crosses above a long-term moving average. A dead cross means a short-term moving average crosses under the long-term moving average. So let me highlight this here. The blue moving average, and I'll get to particular moving averages in a couple of minutes. This blue line is a short-term moving average, and the red line is a longer-term moving average. It doesn't matter what the moving averages are as far as the definition of a golden and dead cross is. So the blue line could be a 10-day moving average, and the red line could be a 20-day moving average. The point is the red line is a longer-term moving average. So when the short-term crosses above the long-term, Japanese call it a golden cross. And if it crosses under the short-term crosses under the long-term moving average, it's called a dead cross. Okay, so that's the terminology. Okay, one of the questions we were asked is the best time period for moving averages. And the answer is, okay, da-dum, and you have it in your handout, so no surprise. 3, we don't know. Question in the back? Simple. For simple people. Simple. The question is, do I prefer a simple moving average? Or an exponential, or a weighted? It's a simple moving average.
Can it be used for Forex?
Can this be used for Forex? Yes. Now, this is based, I mentioned before that Chuck tested 1 million combinations of moving averages. This works fine in stocks and futures, and I've been looking at it in Forex. It works really well in Forex also, but it has not been tested in Forex. But visually, I've seen it work really, really well. So, and this, with this in mind, we're now going to segue into how we could use this with trailing stop. Now, understanding when and where to move stops. So we know where protective stops are. Now we're going to look at a trailing stop. And just to refresh your memory, or for those who know, a trailing stop, once you're in a position, you move the stop up to help protect profits, but also if the market is moving in your direction, to let the profits run. That's the idea with a trailing stop. So let's look at this here. And this is a comment we got from, for one of the challenges. Okay. I usually exit. It corrects somewhat, but then continues to go in the direction after that. So one way around that is using a trailing stop. So let me go through this. You sold at the shooting star. Okay, so we sold either here on the shooting star or on the falling window. Okay, so you're short here and short over here. Okay, you're short here. Okay, the bull harami over here gets you a little nervous. There's some bullish confirmation. Everybody see that? Okay, bullish confirmation. But it gets you nervous, but you're still playing with the market's money. So you may take some profits there, but you want to let it run. So in other words, now what you could do is the blue line is the 3-day moving average. The red line is the 12-day moving average. So the trailing stop would be as long as the 3-day remains under the 12-day, you're in the trade. Under the 12-day, you remain in the trade. The blue line is the 3-day. The red line is the 12-day. And even, how would you know the blue line is a shorter-term moving average, even if I didn't tell you the color? It's much more volatile. The shorter the moving average, the closer it's going to hug price action. So, until you get a golden cross.
So, you want a dead cross when you're short.
Right. Well, let me go back here. That was something that's a good point. The question is, I want a dead cross when you're short. The problem, I'll tell you, the problem with initiating a trade with moving average crossovers is by the time you get the crossover, some of the move had occurred already, right? So This is the best of both worlds. This is really neat. Because what's happening is you had the dead cross here on this session. Look when you got the signal. The beauty of the candles is a lot of times it's going to let you get into the trade before you have the crossover because the candles are reversals. So you don't have to worry about if the 3 is above the 12 or vice versa. It doesn't matter where the 3 and the 12 is when you initiate the trade with the candles. When the trend starts going in your direction, if the 3 starts, in this case bearish, moving under the 12, then you start looking at the trailing stop. It doesn't matter what it's doing when you do the trade, but you're going to find that in many instances, you don't have to wait. Again, as I mentioned before, downside with the crossovers is by the time you get it, a lot of the move is done. With the candles, you're going to get those early reversals. So you initiate the trade, and then once the 3 crosses under the 12, you then start using the trailing stop. And this is where subjectivity comes in. As I mentioned here, a rally from the bull Harami gets you nervous and you exit, okay? So you may exit all the position or some of the position. But the feeling is you may be playing with the market's money, so you may leave some on because, yes, you reached your target, but you want to still be able to ride the trend. So maybe you take some profits, the target is met, but you're now playing with the market's money. So you leave some of the position on, and then you could shift over into a trailing stop. And we're going to look at some instances in a couple of minutes. Again, it's going to be your trading style. So for example, here, let's go here. So here we have a shooting star. Let me go back here. We have a shooting star. Okay, so now we're thinking about buying. We buy down here, and this is our stop out area, the low of the bullish engulfing pattern. Everybody see that? Okay. Our target is the shooting star. Okay. And did the market get there? Yeah. Fine. Take some profits, but you say to yourself, okay, I have such nice profits in there. I got to my target, but I want to still give the possibility of riding the trend. The 3 is above the 12. You leave the position, the rest of the position on, and certainly take some profits. It's better to play with the market's money. Okay? You reach your target, you're riding the trend, and you stay with it until you have the dead cross here, over here. Again, right, or the shooting star. Shooting star, you may take some profits there, exactly. It's going to be your trading style. And the downside, it's not all magic. Sometimes by the time you get the dead crossover, it could be down here. Right? But then maybe if it gets back down to here, you exit.
That's dumping.
Yeah. What's that?
Dumping top?
A rounding top. Yeah, a dumpling top is a rounding top with a gap down. Okay, so yes, pointed out here, you could certainly take some profits there, and if the shooting star on the doji, or you could let more profits run. In this case, you would have been better off taking profits on the doji and shooting star, but you don't know that. But this is a nice way. See, you're getting in. Look, where's the moving average crossover? It's down here, right? You didn't have the crossover yet, but do you have a buy signal down here? So now you're getting in on the trade, and once the trend starts moving up, which is what you're hoping, you want a bull trend because you're buying here. Once you're in the bull trend, you're now riding the trend, and this works really well, even in Forex. Okay, so here we have a hammer, and our potential target is up there. I'd view that as a shooting star. And so we now go over here. Here's the hammer, risk here. Target is over here. We have the doji. It warns of caution. You may decide to take profits, but you may say the doji is making a new high close for the move, but I would certainly take some profits. You want to let the profits run, more profits. You use the golden and dead cross. The 3 is above the 12. You let it run. And, it's not always going to work out this great. But you're going to see, when you look at a lot of your charts, you're going to see a lot of times the 3 is going to get close to the 12, but a lot of times it's going to really let you ride the trend. Doesn't mean you're not going to take profits. Maybe there's some bearish signals there, maybe a bearish engulfing pattern. But this is a really good, these dual moving averages are really good for riding the short term, for riding the trend. So let's go over what we learned here with the protective stops. The exit strategy, protective stops, protecting your assets, right? Oh yeah. Time stops, If the market is not doing as anticipated, then think about exiting the position. Trailing stops is a great way to let you ride the trend using the 3 and the 12-day. Okay, let's talk about setting up a trading journal. And I got this from my good friend Tony. And this is actually from a book. It's a really good book for those who trade the equity markets. It's called Short-Term Trading in the New Stock Market, a really good book. And I got this pretty much from her book. And it's something that, I strongly recommend you use because by setting up how many use a trading journal here? Great, okay. For those who don't, definitely do it. And we're going to show an example of how to use it in a minute. But what that means is you just write down what you do, why you did it. You're going through an objective reason why you're doing the trade instead of just trading by the seat of your pants. So you'll set up the date, the market, the dollar amount committed, why you did the trade. Actually, why you did the trade probably should come down later because you're going to figure out why you did or didn't do the trade. It's going to depend on your entry price, potential entry price, what your risk is, what your initial target is. Risk and initial target, what is that? Risk reward, right? If you don't have a good risk reward, you don't do the trade. Then when you wind up with after the trade, when you exit the trade, why did you exit it? What price? And then you could print out or do a screenshot of the chart and write comments on what happened with the trade. And essentially, what we're doing is, by doing this, you're helping keep emotions out of the market. Okay, we're trading objectively. And even if you have a losing trade, we learn from it. So the Japanese proverb says, take profit from your loss. So even if you lose on the trade, think about what you did wrong or what you did right. You could do everything right and the trade may not work out. But if there might be things by analyzing the trades, you realize what you did wrong. So let's look at an example. Okay, we have an entry price here. We have the risk. We have the target, and then why did you or didn't do the trade. But, okay, so the entry price, we have the bullish engulfing pattern here, right? Okay, the risk is the low of the bullish engulfing pattern, correct? And the initial target, very subjective, but I would say the high over there. Little bearish engulfing, not equal size real bodies, not a strict criteria bearish engulfing pattern, but a bearish engulfing pattern, a pivot high. So you write down why you did the trade. And so why did we do the trade? Was it a good risk reward? Okay, good risk reward. Okay, so now, this is what happened with the trade. Now we're in the time period where we had setting up the trade. Now once the trade is done, when we're out of the trade, either at a loss or a gain, we now go into analyzing the trade. We have an exit price, and now we analyze the trade. Okay? And I threw, by the way, a 3 and the 12. We didn't use it on here, but I threw it on here. So let's look at analyzing the trade. Let's think about what we did right and what we did wrong. Why do you think the trade didn't or didn't work out? Now, from a reward risk perspective, was it fine? Yes. Good, okay. Now, everything might have been okay, but think about what we might have been missing on this trade. What is it? Lack of support. Remember, there are times to use candle signals to initiate a new trade, and there are times to use candlestick signals to offset a current trade. When do we think about initiating a new trade? If a candlestick signal confirms support area. So you might say to yourself, okay, this didn't work out, and then you go through the notes, and you say, oh my goodness, I remember Steve said that to initiate a new candle signal, it should confirm a support level. And I don't know if it did or not, but I'm assuming it's not. So that's a mistake you made. So you write down, idiot, you forgot to look for support, right? Then the reason for the trade, it's a good risk reward, good support area. It's like you say you check the ADX, it happens, it just happens. You could, as long as you have the right reasons for doing the trade, but now you would have learned that, oh my goodness, I forgot to look for a support area. So now you could add that to your educational article, your educational resource. All right, now, here we have support from a few months ago. So let's think about this. Here we have a bullish engulfing pattern. So this is a bullish engulfing pattern here, right? Now, normally, and I'm just going to show you something a little bit more advanced. Normally, we wait for a bullish engulfing pattern for a close of the bullish engulfing pattern to confirm it, because we need open, high, low, and close. Now, if you wait for the bullish engulfing pattern, what about the risk reward? Kind of eyeballing it? It's probably not 2 to 1, right? Reward risk is not 2 to 1. What you could do is, if the market is forming a potential bullish engulfing pattern, in other words, during the session, if the market is doing this, this is why I drew the green line here, you could think about buying it lightly, because with the expectation of what? It's going to be a bullish engulfing pattern. Do we know it's going to be a bullish engulfing pattern? No, not until the end of the day. So what that means is, if you're buying it here, if it doesn't form a bullish engulfing pattern, let's say it closes here, are you still in the trade? It depends, because the reason you're buying it is what? You want it to be a bullish engulfing pattern. But the reason it's not so clear-cut is you might be in the trade because it's still near those lows there. But I would certainly be pulling back for most of the trade, because when you put a trade on, you should have a reason why you do the trade. If the reason is not validated, you get out of the trade. So if you're buying this on the hope that it's going to be a bullish engulfing pattern and it doesn't close as a bullish engulfing pattern, I could see why you would still want to be long. But the main reason for you being in the trade, is that still valid? No. But if you're right, what have you done to the entry price? You got a much better entry price than those who waited for the close. So that would be a fine risk-reward trade there. So let's think about this now. So the entry price is here. What's our risk below the bullish engulfing pattern? The target, that would be my initial target. Yours might be different. Why did you do the trade? You write down the reasons there, and then you analyze here, analyzing the trade. Do we exit here? Is that close to our target? Yeah, it's going to be your call. Analyze the trade. If you exit there, fine, but why do you think I have the 3 and the 12 on there? The 3 is now over the 12, and once again, this is very common. You're going to get the candle reversal signal while the 3 is under the 12, because you're getting in the trade early before the trend starts moving, and that's what you hope for. Now the 3 is above the 12, and this is going to be purely subjective. Do you get out of everything? Do you let some profits run? Again, I think a lot of traders would say, okay, I'm playing with the market's money, I'll take some profits, and let the golden cross work, or the dead cross. You're going to stay long until you have the dead cross. And so here's the trade. Okay, so here, and once again, so here's where you may have exited over here. Some of you might exit on this bearish engulfing pattern. But if you're really playing the trailing stop, it would be, you know, this big black real body would be over here. This would be your exit price. And you analyze the trade. So you say, okay, you took some profits either at the dark cloud cover or the bearish engulfing pattern, but you let it ride. You got out because of the dead cross. Okay. So make sense? So there's a really good way of being very objective, very rational about the marketplace. And really by using trailing stops and analyzing the trade, using a trading journal, you'll be right? That's even better than being a really, really great trader, right? Okay, our challenge is, how can I narrow my analysis down to the most basic and important signals? I don't want to be paralyzed in doing too much analysis. We've heard the expression, paralysis by analysis, and of course I have a cartoon made on that. Okay. So, paralysis by analysis. And what we're going to do now is show you the steps. I've made a slide compressing all what we've done into a few steps. And we're going to look at how to join the ranks of what we learned for candlestick signal, a Western signal, You have your favorite Western technicals. I like ADX, support or resistance, volume. If I had to pick 3 of my favorite, and when I talk support and resistance, horizontal, those are my 3 favorite. Volume, ADX, and support and resistance. You have your favorite. So, third, for those who trade stocks, look at the stock sector or industry group, however you want to refer to it. Go in the direction, if you can, of the sector for a new trade, and to initiate a new trade. Determine, third leg, determine the risk reward. You could have a market that, say a stock, in the same direction as the sector. You could have it confirming a Western indicator. You could have ADX work in your favor. You don't have a good reward-risk ratio, you don't do the trade. And then make sure you monitor the trade. Don't just put the trade on and forget about it. Have a stop, have a protective stop, have a trailing stop, have your exit strategy. Oh, and use a trading journal. Okay? Shouldn't forget about that. It's a great way to organize your thoughts, and you can actually use this checklist on your trading journal. Why you did the trade. Did you have a valid candle signal? What Western signal did you use? Did you check the sector if you're trading stocks? You can actually use this as reasons for doing the trade on your trading journal. The Japanese say, a jewel unpolished will not shine. And I hope that what you learned here today will truly make your trading shine. So I want to thank you so much.